Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Canadian Natural Resources Limited, ticker symbol CNQ. We're looking at Canadian Natural Resources today as a subscriber request. The business also fits in line with the other energy businesses that we've been covering on the channel. So currently, Canadian Natural Resources is trading for $60.61 per share. Over the last year, their stock price is up 18%. This is in drastic contrast to many of the other companies in the market, but is more similar to a lot of how the energy sector has fared over the past year. Over the last 5 years, Canadian Natural Resources is compounding its stock price at a rate of 14.5% annually. The company's stock price has increased by almost 9 times since their lows in March of 2020. Over the last 10 years, they're compounding their stock price at a rate of about 7% annually. And going back prior to the global financial crisis, over the last nearly 2 decades, Canadian Natural Resources is compounding their stock price at a rate of about 10% annually. Keep in mind that the company does pay out dividends additionally. Currently, the business is paying out about a 3.9% dividend yield, which is twice the amount that an S&P 500 ETF would currently be yielding. And so the business's average dividend yield throughout this entire time frame would be in addition to this compounded annual return in their stock price. So Canadian Natural Resources is about $10 below their 52-week high. They're more than $15 above their 52-week low. Right now, about 2.5% of their shares outstanding are currently sold short. And they're a very large business. They have an 89.5 billion Canadian dollar market cap. When we convert that to USD, their market cap is about 67 billion US dollars. So for more background about the business, Canadian Natural Resources is one of the largest oil and natural gas producers in Western Canada, supplemented by operations in the North Sea and offshore Africa. The company's portfolio includes light and medium oil, heavy oil, bitumen, synthetic oil, natural gas liquids, and natural gas. Production averaged 1.1 million barrels of oil equivalent per day in 2020, and the company estimates that it holds over 11.5 billion barrels of oil equivalent of proven and probable crude oil and natural gas reserves. The company was formerly known as AEX Minerals Corporation and changed its name to Canadian Natural Resources Limited in December of 1975. The business was incorporated in 1973 and is headquartered in Calgary, Canada. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Canadian Natural based off of their business fundamentals. So this analysis is still a work in progress, it's an evolving process, and it's an opportunity to learn in public. So it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the typical publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So it's not surprising as an oil and natural gas producer that Canadian Natural Resources is going to see their returns on capital fluctuate with the pricing of those commodities. So when the price of oil went negative in 2020, their returns on capital were actually negative as well. Since then, as the price of oil has rebounded, their returns on capital have strongly rebounded as well. The business earned 15% returns on capital in 2021. And over their last 12 months, they've earned about 27% returns on capital. That's far above where they were in any of these previous years. Even still though, when we average out their past 5 fiscal years, the business is just about producing 7% returns on capital. So that's just about in line with a typical business. And so this is an X here on metric number 1, as the business is only coming in at half of that 14% benchmark we're looking for and has a more typical return on capital profile. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. We're also going to be including their last 12 months worth of numbers in our calculations here. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. Looking at the business from a higher perspective here, we get to see the impact that 2020 really had on the company. While it did significantly cut all 3 of these numbers in that year, it looks like the business has strongly rebounded since. From the end of their fiscal 2017 until today, their revenues have more than doubled, their earnings have quadrupled, and their free cash flows are up more than 5 times. So this is massive growth here for Canadian Natural Resources. Even though the business did take a big hit in 2020, they've rebounded incredibly strongly. So this is a really big check here on metric number 2. Something worth pointing out is that even when they had negative returns on capital in 2020, the business still produced positive free cash flow. This is a potentially big difference between them and some of their peers, as it's great to see that the business has been able to be strongly cash flow generative in all 5 of these years. And over their last 12 months, the business has produced more than $10 billion worth of free cash flow. So again, it's great to see such strong growth here for Canadian Natural Resources. And it's especially great to see this growth led by their strong free cash flows, because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back into the business. And ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So great to see such strong growth for Canadian Natural Resources. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Canadian Natural Resources on a per share basis. So we're looking for earnings per share growth over the last 5 years. With their earnings being up so massively over this time frame, we still want to look at what they've done in terms of their shares outstanding. And over the last 5 years, Canadian Natural Resources has just marginally bought back some of their shares. So they bought back about 1.5% of their shares outstanding. So the main driver of this earnings per share growth comes from their earnings growth. And so because they've had very strong earnings growth, this is going to be a check here on metric number 3. Over their last 12 months, Canadian Natural Resources has earned $7.42 for each share that they've had outstanding. Metric number 4, we're going to be looking for something very similar. So here we're looking for free cash flow per share growth over the last 5 years. Again, a very similar story to their earnings, with their massive free cash flow growth and their slight share buybacks. This is strong free cash flow per share growth here on metric number 4, and this is a check. Over their last 12 months, the business has produced $8.86 worth of free cash flow for each share that they've had outstanding. And so far, through our first 4 metrics, we have 3 checks for CNQ. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. So Canadian Natural Resources ended 2021 with $12 billion worth of net debt. Since then, they've been continuing to steadily pay this down. Right now, they have about $9.8 billion worth of net debt. So they brought their debt position from where they were at in fiscal 2020 down by more than 40% over the past couple of years. Additionally, over the last 5 fiscal years, Canadian Natural Resources has produced just under $20 billion worth of free cash flow in all 5 of these years, meaning that the business is easily able to support this debt load with their historical free cash flows. Additionally, over their last 12 months, the business has produced $10.2 billion worth of free cash flow. So they'd be able to pay off all of their net debt with only 1 year's worth of their free cash flows. This is another big check here on metric number 5, as relative to the leverage that the company is employing in their business, it looks like the business is very cash flow generative. Last but not least, the big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a reasonable starting point for a valuation of the business, and it may offer a slight risk premium to the yield of the 10-year treasury. So currently, Canadian Natural Resources has a $77 billion total enterprise value, and we're utilizing their enterprise value because it takes into account both their net debt position and their market cap. So it's going to give us a perspective of the business that's more similar to as if Canadian Natural Resources were a private company. So we learned in the last 5 years that the business has produced just under $20 billion worth of free cash flow net, meaning that in an average year, the business is producing about just under $4 billion worth of free cash flow. So when we divide their $4 billion of their average free cash flow by their $77 billion total enterprise value, that gives us about a 5.2% average free cash flow to enterprise value yield for the business. So that is just very slightly above that 5% risk premium we're ideally seeking. So on an average basis of their historical free cash flows here, this is going to be a check on metric number 6. Also, again, worth being aware of is that their free cash flows over their last 12 months are significantly above where they've been at historically. So the company has produced $10.2 billion worth of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $10.2 billion of their last 12 months of free cash flow by their $77.3 billion total enterprise value, that gives us about a 13.5% current free cash flow to enterprise value yield for the business. So that would be massively above that 5% risk premium. So with both their average and their current free cash flow to their enterprise value yield coming in above that 5% risk premium we're ideally seeking, Canadian Natural Resources could be a very interesting business to dig in and learn more about. Just because this is a check here, though, doesn't mean that you're going to run out and go buy the business. This type of analysis is not a buy or sell recommendation of any security, and it's meant to be taken in holistically. This is one of our 6 metrics, and while these metrics are simple, when they're combined together, they can be very powerful. And we've still got some interesting aspects of the business left to cover. Then as a bonus, here we're taking a look at Canadian Natural Resources dividend profile. So again, Canadian Natural Resources pays out a 3.9% dividend yield, which is more than double that of the dividend yield of an S&P 500 ETF currently. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business and to determine whether that company's abilities to pay out dividends are going to be supported by either their earnings or their free cash flows, depending on the type of business. For Canadian Natural Resources, we want their dividends to be well supported by their free cash flows, and the business has been able to support these dividend payouts in all 5 of these years. They've also managed to steadily grow their dividend payouts per share, and throughout this time frame, they've grown their free cash flows per share as well. The business had a pretty high payout ratio in 2020. However, since then, as the price of oil has rebounded, the company's dividend payout ratio has gone down quite a bit. And the company currently is paying out less than 25% of their free cash flows per share as dividends to shareholders. So because the business is a cyclical commodity producer, their free cash flows are going to depend on these commodity pricing. However, it does look like Canadian Natural Resources, if the price of oil is going to be more typical as it is now going forward into the future, would have plenty of free cash flow to be able to support these dividend payouts. Again, though, keep in mind that this is a snapshot of the past 5 years of their performance, and this is not necessarily a guarantee for the future. Then everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Canadian Natural Resources, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Canadian Natural Resources. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over their last 5 years, to give us a more normalized perspective of the business's abilities to produce free cash flows. Then we're using historical growth assumptions dating back over the past 30 years to project these average free cash flows out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be potentially accurate and applicable going forward for Canadian Natural Resources in order to give us a baseline projected estimate of the company. So if we assume that the business grows their average free cash flows at a rate of 4% annually for the next 10 years, and then these free cash flows decline to a growth rate of 3% annually for the 10 years out after that, if we add in the company's tangible book value today, which gives us a perspective of the tangible net worth of the business, and we were ideally seeking a 15% rate of return, which is the rate of return that Warren Buffett is looking for from his investments, albeit with a significant margin of safety depending on the qualitative aspects of the business as well, and the dynamics of the industry and the business's competitive advantage within that industry. From today's valuations of the business, it looks like a potential fair intrinsic value for Canadian Natural Resources is around $67 per share. So that's about $7 above their current stock price. So it does look like there would be a slight margin of safety in the business in addition to this 15% rate of return. So please keep in mind some caveats here though. Number one, we would not be doubly counting their dividends in this discount rate. 3.9% of this 15% rate of return would be coming from their dividend yield to shareholders, so we would not be doubly counting their dividends. Secondly, and very key, is because of the type of business that this is, their future free cash flows may not be as predictable as the future free cash flows of some other types of businesses, and a discounted cash flow model is really based off of the predictability of those future free cash flows. So it really requires you having some sort of insight into the business and into their industry in order to understand where their free cash flows are really likely to be at. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about our summary for Canadian Natural Resources, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a potential long or potential short thesis of the company? So starting with some of the key points around a potential long thesis for the business. Number one, the company's production from light, medium, and synthetic oil attracts higher price realizations. Number two, growth opportunities from non-producing oil sand properties provide Canadian Natural with several decades of crude production. And number three, Canadian Natural's cost structure, which is driven by the integration of its midstream pipeline assets, compares favorably with peers. Then for some of the key points around a potential short thesis of the company. Number one, the oil sand projects are geographically isolated from end markets and remain exposed to low price realizations and high production costs. And number two, Canadian Natural's oil sands growth projects were not economical in the previous low oil price environment, and the timing of their expansion was highly uncertain. Also in the past, their high debt levels limited spending on production growth opportunities, and they raised concerns about meeting debt obligations. Although as the price of oil has rebounded, it would seem to be the case that this is no longer that much of a concern for the business. So hopefully that offers a potentially balanced perspective around some of the key qualitative points of the business. Now it's time for a wrap-up. So in summary, Canadian Natural Resources checks the box on 5 out of our 6 metrics. Their only X of the day came because the company has earned just about average returns on capital over their previous 5 fiscal years, although they're earning 27% returns on capital over their last 12 months. The business's revenues, earnings, and free cash flows have really exploded over the last 5 years, with the company just very slightly buying back shares. They've had strong per share growth over this time frame. The business has also significantly deleveraged itself, reducing their debt position by about 40% over this time, and very easily being able to support that with both their current and their average free cash flows. Then the business looks like it's potentially attractive on both an average and a current basis of their free cash flows to their enterprise value yield. When we compare that to the yield of the 10-year treasury, that looks like that's giving us a slight risk premium on both. Looking at the business's dividend profile, while their dividends did come under pressure in 2020, the business was still able to support those with their free cash flows, albeit with a very high dividend payout ratio. In all 5 of these years, the business has grown their dividends and they've been able to support them with their free cash flows. And as the price of oil has risen post the COVID-19 pandemic lockdowns, the business has very easily supported their dividends with their free cash flows. Finally, performing a discounted cash flow analysis of Canadian Natural Resources. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the business, and you are ideally seeking a 15% rate of return from the company, then it looks like a potential fair value for the business is right around $67 per share. So with today's valuation multiples and at today's current stock price, that looks like there would be a slight margin of safety in the business. However, keep in mind, again, that the business operates in a cyclical industry and they're a commodity producer. And so the oil and natural gas industry has gone through its periods of boom and bust cycles. Although it does look like the industry is currently in a period of low CapEx spend overall, they've pretty much just gotten out of an entire decade of very high CapEx spend, where much of the industry was operating at a growth at all cost mindset. So that's just something to be mindful of, and it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether or not it's worth your time and energy to dig in and learn more about Canadian Natural Resources. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company, learning about the business accurately, completely, and then going back and asking yourself, what did you miss, in order to come to the underlying essence of that business and understand what's going to be important and what's not important for the company going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Canadian Natural Resources, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Canadian Natural Resources Limited, ticker symbol CNQ. We looked at the business again as a subscriber request today, and because it fits in line with looking at our other oil and natural gas energy businesses, so I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Canadian natural resources with me, and have a great day.